Hello, everyone, and welcome to the Kentucky Small Business Development Center's weekly webinar. I'm Dave Etkin. I'm the director of the SBDC Center in Louisville, Kentucky. I'm really glad you're here today. I see that a lot of folks are coming and joining in, so we'll give everybody a minute to join. But before we get started, I'd like to take a few moments to share some info about the Kentucky SBDC. The Kentucky Small Business Development Center is the only statewide, nationally accredited program that provides entrepreneurial and business development services to assist Kentucky's entrepreneurs at every stage of their business life cycle. For almost 40 years, the Kentucky SBDC has assisted emerging and growing businesses by providing the professional expertise, tools, and information necessary to make sound business decisions in a complex and ever-changing marketplace. We do this at no cost to our clients, thanks to the U.S. Small Business Administration, the University of Kentucky, as well as regional universities, colleges, and local economic development agencies. We're also part of a national network, America's SBDC, with over 1,000 centers across the nation. To learn more, visit KentuckySBDC.com, and there you'll find additional resources to help start, fund, and grow your business. If you'd like to request personal assistance, please email us at info@KentuckySBDC.com or just give us a call at 1-888-475-7232. If you look to the right of your screen, you'll find the chat feature. So as we go through our presentation today and you have any questions for our presenter, just put them in the chat and we'll answer them at the end of the presentation. And just to test that everything's working, you can hear me well and see the screen. Do me a favor. Just put a little chat in there, say hello, and tell me where you're joining us from. I see that Paul's already jumped in there. Good to see you. Paul's here in Louisville with me. All right, Paul. Again, I'm Dave Etkin. I'm the director of the Louisville Center here. We're one of 17 centers across the Commonwealth of Kentucky. Today, we'll be sending you a copy of today's webinar, and we'll email that to you this afternoon. Also, a little bit later in the chat, we're going to put up a little survey link. If you would really help me out, if you would just click on that survey and tell me, let me know what you think about our presentations and give us some feedback on that. So I see that Tony's joining us and Shanna and Suzanne. Good to see everybody. Well, today we've got a very, very special guest. I'd like to introduce Andy Freed. He is also a SBDC consultant. He's with the Georgia SBDC. He's located in the Kennesaw State University there in Atlanta. He's an SBDC, and he has a ton of entrepreneurial background. He, as I said, he's a CPA, and he's one of these finance guys that I really enjoy. I kind of like the finance background myself. Andy did a great presentation at a conference that the SBDC had last year, and what he talked about and was just was awesome. And I wanted to get him on. He was gracious enough to come and tell us a little bit about the 1% solution. And so, Andy, welcome. Good to see you today.
Thanks, David.
So let's just jump right in and talk about the 1% cash flow solution, Andy.
Super. Thanks, David. Thanks for the introduction, and I'll take it from here. And if you could put your mic on mute, that'd be great. Just to repeat, I'm from New York. I'm a CPA. Did that for several years, and then I went to the retail world. I owned a retail business with locations in New York, New Jersey, Connecticut, and a couple locations in Florida. Sold my interest in the business and moved to Georgia, got involved in commercial real estate, owned commercial properties in New York and Georgia, and I've had the privilege for the last 14 years to serve the small business community at the Kennesaw State University Small Business Development Center. So, David, thank you for inviting me. Today we're going to talk about small changes that can make a large impact in your profits and cash flow. And most of us are familiar with the levers on our profit and loss statement. We understand the profit and loss statement. It informs us of profitability, sales, expenses. These are things that we're very familiar with. And there are 4 levers on the profit and loss statement that can improve profits and cash flow. This we're going to run through fairly quickly in this hour. But the second part of improving cash flow involves the balance sheet. There's 3 levers on the balance sheet that we're going to take a deeper dive into. We are in a pandemic, and it would not surprise me at all if a lot of you guys out there on this call today are doing good business. You're profitable, but you look in your checkbook and like, where's the money, right? And there might be money there because you've got an infusion from the EIDL loan, you got an infusion from the PPP. But if you strip away the PPP and the EIDL loan, and you look at your balance sheet, and you may say, without that support, I would not be in business. Okay. So we're going to look at the levers on the balance sheet that can improve cash flow. These are powerful levers and provide for a rich conversation today. And then after we discuss the 7 levers, the 4 on the P&L and the 3 on the balance sheet, we're going to summarize the effect of these small changes. We're going for illustration purposes, we're going to look at a 1% solution on the profit and loss statements, and we're going to look at a 1-day solution on the levers on the balance sheet, and then we're going to add up the sum of these small changes, these 1% solutions and 1-day solutions, and see how it affects our cash flow. And then, since that is all kind of conceptual, it's real, but it's conceptual, we're going to put it to work, and I'm going to show you the tools that I use with my clients, that my clients use for themselves to empower themselves and improve their business. And Ryan, at the end of the session, will share with you all the tools, all the Excel worksheets, so you guys can do it on your own. And if you guys need assistance, you'll follow up with David, and you'll make appointments with David and his staff, right? So let's get started. So we're going to start with the profit and loss statement. This is, like I said, this is going to be a very easy conversation. There are 4 levers on the profit and loss statement that can improve profits and cash flow. And when I say profits and cash flow, I'm talking about improving profits, because if you improve profits, those profits are going to turn into cash, right? So improving profits improves cash flow. And, the reality is that the profit and loss statement doesn't say anything about cash flow. It informs on profitability, but unless we're, running a lemonade stand or driving an Uber, your profit and loss statement doesn't say anything about cash flow, right? So, you're selling widgets to Home Depot, you record the sale in the month that you shipped it, on the day that you shipped it, but Home Depot doesn't pay their bills for 60 days. So your profit and loss statement could look fabulous, but your checkbook could look really poor, right? I mean, I've heard that, or I've read that 40% of all small businesses go out of business because they don't have cash. They're undercapitalized. So it doesn't make sense that 40% of the businesses that are profitable go out of business, but it's reality. And you've heard that businesses go out of business because they're undercapitalized, and we're going to explore this today. In fact, we are really going to look at, the balance sheet. That we're going to spend a lot of time on the balance sheet today. In this little hour, we're going to really tackle some of these big things, so that at the end of the year, when the year's up and you look at your profit and loss statement and you had a great year, and you go home and you tell your spouse, your wife or your husband, honey, we really had a great year, and your spouse says to you, so where's the money, right? So we've all been there, and we want to understand that better, and we want to do some tactics to really align our cash flow with our profits, okay? So the first lever on the profit and loss statement is a simple price increase. So let's just say the company, for illustration purposes, does $1 million a year, and it issues a 1% across the board price increase. So that would have the effect of adding $10,000 directly to the bottom line. I would say to you that this is by far the most powerful lever that a company has, a price increase. And I would say oftentimes that there's a disconnect with the small business owner with the power of a price increase and its effect on the bottom line. Okay, a 1% increase adds $10,000 to the bottom line. I mean, that should be pretty easy. I mean, if you're selling widgets for $50, a 1% increase would be 50 cents, right? Warren Buffett has said that if you need to have a prayer session to have a 10% price increase, this is not a good business model. This is not a business model that he wants, right? But we're just talking about a 1% solution here. So 1% solution on $1 million sales, that's $10,000 to the bottom line. Your action item would be to go back to your office, see where there's an opportunity. And I'm not prescribing a 1% across the board because you have to pick and choose where there's opportunity. But you need to look at where there is opportunity. If there's a 5% increase someplace, then do it. If there's 10% opportunity someplace, do it. If there's no opportunity, don't do it. But we're looking for a simple 1% solution, right? All right. The second lever is we sell more. So if this is a company that's doing $1 million a year in sales and it's working on a 60% gross profit margin, and it does 1% more, it does $10,000 more in sales, and it works on a 60% gross profit margin, then we're going to add $6,000 to the bottom line. Now, a sales increase involves a little bit more work than a price increase. I mean, to sell more, you need to perhaps market more. So there may be an increase in overhead. So this may not be such an easy lever to execute, but it's certainly something that we need to consider. So the price increase, we've yielded $10,000 on an increase in sales volume of 1%. We generate another $6,000. We're up to $16,000. And the third lever on the profit and loss statement is better sourcing of our cost of goods sold. So, negotiating harder with our vendors, right? So if this company's cost of goods sold, we know it's 60% gross profit margin, so we know our cost of goods sold is 40% or $400,000. And so if we better source our materials, better source our labor to the extent of 1%, that will add $4,000 to our bottom line. So $10,000 from the price increase, $6,000 from selling 1% more, $4,000 for better sourcing our labor and materials. We've already added $20,000 to our bottom line on a company that's doing $1 million. We've already added 2% to our net profit margin, right? So there's companies out there, if you're in the retail business, some of you guys are working on 5% net profit margin. And if we just added 2% to your net profit margin, we've increased your net profit by 40%. So, these are things that we need to make time to work on these tactics, these strategies, on these levers. And the fourth, and we're really flying through this profit and loss, we're flying through the levers on the P&L, and the P&L is something that you guys understand. These things, this is nothing new to you guys. I'm not sure that you make time during the day, during the week, during the month, during the year to work on your business. I mean, we always work in our business. We grind it out. We have the privilege of owning our own businesses, and we work 60-hour weeks. But at the same time, in that 60-hour week, grinding it out, we may not be making any time to really sit down for a couple hours a week just to focus on the business and how am I doing and what can I be doing better, right? And so, a good best practice if you're not doing it already, is that by the 10th day of every following month, you should be printing your financial statements, your profit and loss statement, your balance sheet, your cash flow statement, by the 10th day of the following month, or the 15th day at latest, and take a look at it and see how am I doing. But if you're waiting to the end of the year to ask your CPA, how am I doing? That barn door's been left open for 12 months, right? So, if you guys, there's a lot of you guys on this call today. I know that, I see that. Make the time to work on your business. Print those financial statements by the 10th day of the following month, by the 15th at latest. Use the tools that I'm going to show you and share with you, prescribe to you guys. And work it, right? Okay. So the fourth lever on the profit and loss statement is reducing overhead. So, I am sure there's a 1% solution somewhere in your overhead. And I'm sure, you guys we're still in this pandemic, and I'm sure that you guys have combed through every line item on your profit and loss statement, on your overhead items, and see where you can cut back. I'm sure of it. And we really know, the easiest target in your overhead is payroll, and that's a slippery slope. Cutting your employees. It's not something that you really want to do if you don't have to. But if this company has overhead of $450,000 and you can trim it by 1%, you've just added $4,500 to the bottom line. So all in all, a 1% solution on the four levers on this company, on the profit and loss statement, we've just added $25,000 to their bottom line. And that has impact, a lot of impact. It adds up to 2.5%. A company that was doing 5% and we just added 2.5%, we just increased it by 50% in net profit. So that's substantial. Okay. So we just tackled in record time the four levers of the profit and loss statement. And now let's change directions and go to the balance sheet. So there are three levers on the balance sheet. So we're looking at improving our cash flow, right? And I would say to you guys that, and I don't want to get too deep on this, and maybe Dave will invite me back for another conversation with you guys. But, if you're managing your balance sheet effectively, if you're managing those assets and liabilities that affect cash flow from operations efficiently, then if you look at your cash flow statement, that cash flow from operations should be equal to or higher than your net income. Okay, and let's not go too deep into this, but I will tell you that Warren Buffett believes that the cash flow statement is the most important of your financial statements. And I'm telling you that if you're managing those assets and liabilities that affect cash flow from operations, that your cash flow from operations should be equal to or higher than your net income, right? And so when you print your monthly financial statements by the 15th of the following month, print your balance sheet, print your P&L, and print your cash flow statement. And you know what? Today, go back to your office and print your cash flow statement and compare cash flow from operations to your net income for the same period of time, for the first quarter or for all of 2020, just the same period of time, and compare it and see if your cash flow from operations is equal to or higher than your net income. Now, if it's not, I could tell you that the problem is in either your accounts receivable, your accounts payable, or your inventory. And, I dare say, we're in this pandemic, that it would not surprise me at all that your cash flow from operations on your cash flow statement is either less than your net income or it's even negative. It wouldn't surprise me, because what's going on in this pandemic? you can't go to the bank and borrow money. You got your money through the EIDL loan, hopefully. You got some PPP money, but good luck going to the bank and borrowing money. So what do people do? You buy from your vendors, and instead of paying net 30, you string it out to 40, 45 days, 60 days. So you've been doing that. I'm sure you've been doing that, and you've been doing that because your customers aren't paying you that fast. So you're just kicking it up the road, right? You're selling widgets to one of your clients, one of your customers, and they used to pay you in 10 days, 15 days, and now they're paying you in 30 or more. And you can't go to the bank and borrow money. And so, you've got money just caught up in accounts receivable. And if you're in the business of, if you're a manufacturer or retailer and you've got inventory, your sales aren't what they used to be. You might just have too much inventory, so you're not turning the inventory over fast enough. So money's getting hung up in receivables. Money's getting tied up in inventory. And the only lever that you have at your disposal is paying slower, right? And turning your vendors, turning your customers into the bank, turning your vendors into the bank, right? And it's not what you want to do, because you want to be a valued customer to your vendors. When you need product, you want the vendors to ship you right away. But if you're paying slow, so, while you might be paying slow to your vendors now, that's just a slippery slope, right? Okay. So, I want to give you guys an illustration of a company that goes out of business, that's profitable, that goes out of business because they're undercapitalized. They don't understand the levers on the balance sheet. They're undercapitalized because they don't even know what that means, right? They don't understand. They understand the profit and loss. They understand profit margins, net profit margins, controlling costs. They just don't understand the levers on the balance sheet. So this is a client of mine, and she's a cupcake baker. She's an extraordinary cupcake baker, but she's a hobbyist. She just makes it for friends and family. And so she wakes up one day and she tells her husband, she says, honey, you know what? I'm going to bake a dozen cupcakes, and I'm going to call up the manager of the Costco on Barrett Parkway in Kennesaw and introduce myself and see if she would, meet with me and try my cupcakes and see if we could do some business. He says, honey, that would be amazing. Just understand that we've got $10,000 and, give it a go. So she bakes 12 cupcakes. She calls the manager of the Costco on Barrett Parkway. And the woman says, come on down, let's give it a shot. And she meets with the woman later in the day. And the director says, these are incredible cupcakes. Let's give it a shot. But you need to understand that we pay our bills net 60 days. Now, she has no clue what that means. She has no clue that she has a 60-day sales outstanding. Her DSO is 60 days. It takes her 60 days to collect her money from Costco. It means nothing to her. She goes home. She and her husband are high-fiving. Husband says, how'd it go? And she says, it was just perfect. But, the woman said to her that they pay the bills net 60. What does that mean? It says you won't get, you ship a product and they receive it. You won't get paid for 60 days upon receipt of the product. Oh, okay. Still means nothing to her. And he said to her, the husband says to her, he says, honey, if you're selling to Costco, instead of going to Publix or Kroger's and buying your product, why don't you buy it at wholesale from Cisco? And, you could buy it at better prices and make better margin. She says, I'll give it a shot. She calls up Cisco and introduces herself. And Cisco says, let's give it a shot. We're happy to sell to you. You've got Costco as a client. And typically we sell to new clients COD or CBD, collect before delivery, or COD, collect on delivery. But since you're selling to Costco and they're a AAA client, you know what? We're going to give you 30-day terms, net 30-day terms. Now, all of a sudden, she knows what that means. So she's got to pay her bills in 30 days, and she collects the money in 60 days. but she still has no clue what this means with respect to cash flow. All she knows is she's got an order, she's got a client, a customer, she's got a source to buy product at a nice discount. She's going to make some margin, she's going to make some money, and she's in. So let's see what this means in English. In the very first month of business, she sells $20,000 to Costco. She works on a 40% gross profit margin, which is super. It's $8,000 gross profit. She's got her pesky overhead for payroll, utilities, insurance, rent, all that good stuff. And in the very first month, she lost $2,000, which, for the first month in business, that's fantastic, right? But on a cash flow basis, she starts her business with $10,000. Nothing comes in because Costco pays their bills in 60 days net, right? But on the money going out, she doesn't have to pay Cisco because Cisco gives her 30-day term. So nothing goes out to Cisco in the first month, but she certainly has to pay her pesky overhead to the landlord, to the utility company, to, her employees, right? The employees want to get paid. And so at January 31st, she's got zero in her checkbook, okay? So we get into February, sales go up 50% in February to $30,000. She works on a 40% gross profit margin. She makes 40 cents on every dollar she sells. That's fabulous for this business. She still has $10,000 of overhead for the rent, utilities, insurance, payroll. And in her very second month, she turns a profit of $2,000. Okay, so this woman is on her way to being a very successful businesswoman, right? But on the cash flow basis, on February 1st, she's got nothing in her checkbook because on Jan 31st, she had zero. So on February 1st, she has zero. Nothing comes in from Costco in February because they pay net 60. So nothing happens there. But on the cash outside, she has to pay Cisco the $12,000 from January and the $10,000 of overhead in February. So $22,000 goes out, and she's negative $22,000 in her checkbook. And then in March on the P&L, again, sales go up 50% to $45,000, 40% gross profit, $18,000 gross profit, $10,000 overhead, $8,000 in 1 month profit on $45,000 of sales. I mean, this woman's working on like 17% net profit margin. Anybody on this call today working on 17% net profit margin? This woman's a rock star, okay? So we go back to the cash flow statement. She's got minus $22,000 in her checkbook on February 28th, March 1st, $22,000 negative. Finally, Costco pays the $20,000 from January. She pays the $18,000 of overhead. Oh, so she's got the $20,000 in, but then on the expense side, she's got to pay Cisco's $18,000 from February. She's got to pay the $10,000 of March overhead, $28,000. And on March 31st, she's got minus $30,000 in her checkbook, right? So I know you guys are out there thinking, this is a woman that was out of business on January 31st. This woman never even saw February 1st, guys. You pay your bills with cash and not profits. This woman had a beautiful business model, but she didn't understand cash flow. She had $10,000. She had the money go, she buys, she sells, and she collects. Business is buying, selling, and collecting. So she buys and sells immediately, right? She gets deliveries from Cisco 3 times a week. So she has no inventory issues at all. Her issue is the time between she sells and collects. She's got a 60-day collection period, okay? But she's got, the money goes out on the 30th day to Cisco. So the money goes out on the 30th day, and it comes back in on the 60th day. This woman has a 30-day gap. Her average daily sales are $1,500. She needs $1,500 times 30 days. She needs $45,000 in her working capital. She had $10,000. This woman can't get through the gap. Plain and simple. She was undercapitalized. We've heard this over and over. Businesses go out of business because they're undercapitalized. Businesses go out of business because they're undercapitalized because they don't know how much capital that they need. They don't understand this gap. In business, they call this the cash conversion cycle, but to me, it's the gap. And I'm always thinking about the gap, right? This woman built her profit model, was perfect. Her overhead's controlled. She worked on great gross profit margins, fantastic net profit margins. But if you're not managing the balance sheet, if you don't understand the levers on the balance sheet, you're not going to make it. And so when I said to you at the outset that 40% of the businesses go out of business because 40% of the profit, 40% of businesses that are profitable go out of business, this woman here, Mrs. Cupcakes, she's a statistic. She's one of them. And I know what you're saying. You're saying, Andy, listen, if you're a consultant, why didn't you tell her that she needed $45,000 of working capital when she started this business? Because if she doesn't have $45,000, she's going to grow broke. That's not an expression I made up. That happens every single day, growing broke. This is an illustration. This is not one of my clients, but this is a client. This is a client. This is small business. This isn't, companies on Wall Street where you can just, issue more stock. You can lose money like Amazon for the first 10 years of operation. Just sell more stock and more stock and more stock until you turn it into a profit. Just go into Wall Street and sell more stock, or go sell more bonds to bondholders on Wall Street. This is small business. There's no allowance for error here. Yeah, she understood gross profit margin, net profit margin, overhead, overhead maintenance, controlling it, but not a clue about the balance sheet. What we do as small business owners, we try and match. If we don't have inventory, okay, we always try to match our collection period with our payable period. If it takes us 30 days to collect, we try and pay our bills in 30 days. That's beautiful business, right? But if we have inventory, we know that there's going to be days in inventory. Walmart has 45 days. Walmart turns the inventory over in 45 days. That's just freaking remarkable. Target turns inventory over in 60 days, right? But small business retailers, maybe 90 days. So if it's 90 days, days in inventory, DII, 90 days in inventory, and then it takes 30 days to collect from Home Depot. So we buy, we sell, we collect, that's 120 days. And then we've got to pay our vendors in 30 days. We've got a 90-day gap, And let's just say we're doing $1 million a year in sales or $3,000 a day. $3,000 a day times a 90-day gap, we need working capital of $270,000. Now, that's not being inefficient, guys. That's just a playing field, okay? So inefficient would be if it's 90 days, but all of a sudden that 90 days turns into 100 days or 110 days, that gap. We're prepared for the 90 days. We know what the playing field is. We know what the arena looks like, right? It's a 90-day deal. If you guys want to sell to Home Depot, you know that it's going to take 60 days to collect. If you want to sell witches to Coca-Cola, our hometown team here in Atlanta, they pay their bills in 120 days. Verizon Wireless, also in Atlanta, they pay their bills in 120 days. That's the playing field. But you need to have working capital to play in that game, right? Okay, so let's take a look at the levers of the balance sheet. We've already discussed them. That cycle of buy, sell, collect, buy, sell, collect, buy, sell, collect, that's a circle, right? It goes like this. Buy, sell, collect, buy, sell, collect, buy, sell, collect. The idea is to get around that circle as fast as possible. Buy and sell as fast as possible. collect our money as fast as possible, right? Around, because if it takes a long time to go around, we're going to have a very large gap, right? So the idea is to make that circle as short as possible, a short days in inventory, a short collection period, right? You know, we've all played the game Monopoly. You know, the way to win that game is velocity, getting around that board as fast as possible and collecting the $200 when we pass go, and then buying houses and buying hotels before our competitors do. That's how you win the game Monopoly. That's the same game we're playing in business. It's all about velocity. Shorten a day's inventory, shorten our collection period. So in this picture, you know, let's just say our days in inventory was 60 days and our collection period is 30 days. That's 90-day total cycle, right? Total buy, sell, collect. And then if we have to pay our bills in 30 days, okay, so that means the 90 days, we turn our money, we turn our inventory into cash in 90 days, but we've got to pay our bills in 30 days. So the money goes out on the 30th day, comes back in on the 90th day. We got a 60-day gap. How do we shorten the gap? Well, if we pay slower, if we get 45 days, we just shorten the gap, the green area, by 15 days, right? If we collect our money faster than 30 days, it moves this way, we shorten the gap. If we turn it over faster, it even shortens that gap even more. We have to be thinking how to shorten this gap as much as possible. How can we be the least dependent on banks? Because, you know, when you guys are undercapitalized, that's when the banks don't lend money to you. You know, they lend money to you when you don't need it. When you need it, you know, when you've got a working capital crunch, working capital meaning current assets minus current liabilities. That's what working capital by definition is, current assets minus current liabilities. And we look at it as a ratio, current assets divided by current liabilities. You just, you know, go back to your office, look at your balance sheet and look at current assets divided by current liabilities. That number should be 2 or better. For every $1 of current liabilities, you want to have $2 of current assets. That would be a nice place to be. More, a ratio better than that, fantastic, okay? But if your current ratio falls below 2, and you're saying, I'm not sleeping so good at night, right? I'm going to go to the bank and see if I can borrow some money. Well, when you go to the bank, the first thing they're going to ask for is your balance sheet. And they're going to look at your liquidity ratio, you know, your current assets compared to your current liabilities. How well you're positioned to pay those bills that are coming due very soon. And if that ratio is less than 2, then they're nervous. This is when they don't lend money to you. And so we need to figure out ways to be less dependent on the bank. We need to shorten our collection period, shorten our days in inventory, and hopefully, if you're an important customer to your vendors, maybe extend the terms with your vendors. Pay them slower. I know that's a slippery slope, but you know, if you are a valued customer to your vendors and they're giving you 30-day terms, and you promise them that, you know what, going forward, I'm going to give you 40% of all my business, but in return, I'd like to get my terms extended to 45 days from the 30 days. You just picked up 15 days. You just shortened your gap by 15 days. So these are the levers at your disposal. You're shortening your inventory, your DII, collecting faster, DSO, and then extending out your DPO. In this illustration with this company that's doing $1 million in sales, if we collect our money one day, just simply one day faster, that's going to add roughly $3,000 to our cash flow, right? If we, and before we move on further to the other two levers, you know, you might be saying, how do I shorten my collection period? You know, collect deposits, I'm not sure if you guys are collecting deposits. I mean, your practice may have been all when the job's completed, whether you're in the service business or a product business, on completion, we get paid, right? A better practice would be taking a very healthy deposit up front and then balance due on completion of the job, and no terms, no 30-day terms, no 60-day terms, no terms. 50% deposit, balance due on completion. Listen, in this pandemic, I think in this country, I think everybody developed an appreciation for the pain that small businesses go through. I mean, we're aware of just the challenges that we experience, and asking for deposits. We can't be the bank. Small businesses just can't be the bank. At this point, we know that. How many businesses closed during this pandemic that will never reopen? Asking for deposit is just good business, and then balance due on completion, that's good business. Having your customers pay sooner. If you're doing B2B, give them incentive to pay sooner. Give them terms. Offer them terms. 2%, 15, 2/15. Give them a 2% discount if they pay in 15 days, and then they pay. If they don't take the discount, they pay in 30 days. I have a small business client that sells pretzels. They manufacture pretzels. They sell pretzels to Whole Foods. Small business. Whole Foods, believe it or not, I know it's Amazon and they're really not small business friendly, but Whole Foods is, at least in Atlanta. And my clients who are not bankable, they just can't go to the bank and borrow money. Whole Foods pays them 2% 10, right? They take a 2% discount and they pay them in 10 days. Without the 10-day payment, they would be broke. Okay. And with respect to invoicing on time. When you deliver that product or provide that service, invoice right away. Because if you wait to the end of the month, all of a sudden you've just extended, your DSO. So you can't do that. So timely invoicing. If you've given your client 30-day terms, then a friendly reminder on the 27th day or 28th day that the money is due in 2 days. And then if you've got a situation where it's recurring invoicing, let's just say you're a landscaper and every month it's the exact same amount, put it on automatic draft. Automatic draft, hopefully ACH payment. That would be beautiful, because ACH payments are just 50 cents a transaction or maybe $1 transaction. Better than a credit card where they take 2.5%, 3% of your sale. Much better using ACH. And perhaps maybe the problem is in communication. Maybe, you're just you're doing a job, you're providing a service, delivering a product. Your relationship is more transactional than a relationship. You don't call up after the job's done. Ask how things went. And so since there's bad communication, they just put your invoice at the bottom of the pile because you're just a vendor. You're just not important to them. And so these are some things you consider. And then a very powerful solution would be if you are selling to Coca-Cola or Home Depot, you can sell that receivable, right, to a factor who will pay you the next day or the same day. But you need to understand that the factor will charge you 2.5%, 3% a month of that sale amount. For however many months. So, if you're undercapitalized and you don't have access to the bank, then, you consider a factor and you get your money right away. But you need to understand if they're charging you 2% a month and it takes you 3 months to collect, that would be 6% of the sale that you're giving up. And let's just say if you're working on 6% net profit margin and then you're giving up 6% to the factor, then you can't afford it. You'll be broke. But Mrs. Cupcake, she was working on a 17% net profit margin, and she had to wait 2 months to collect her money from Costco. So if Costco, that's a AAA client, she could find a factor that will charge us 2%, right? So 2% for 2 months, that's 4%. She's making 17% 17% net profit margin, she's got no problem giving up 4 points and, making 13% net profit margin. She's still making a net profit margin of 13%. That's winning. Now, we understand that 2% net profit, 2% factor fee annualized, that's 24% interest charge. I mean, that's criminal, right? 24%. So we need to understand that using a factor is a short-term solution, that Mrs. Cupcake needs to factor the receivable, get the money, build up her balance sheet, build up her working capital, and then go to the bank and get a line of credit or get a term loan and get rid of the factor. Because if she goes to the bank, she'll get a 6% interest rate. So that's a fraction of the 24% rate that the factor charges, right? It's 1/4. So the idea is to, if you can afford to, use a factor in the short term, understand that it's just a short-term solution, and then build up your balance sheet, and you go to the bank and get a real loan, right? Okay. And then we've discussed this. We want to, inventory. All inventory it's frozen cash. We need to just turn that inventory into cash. We need to turn it over faster than we are, right? And turn it into cash quicker. The only way to do that is by reducing inventory. So if we reduce inventory by the amount of 1 day, that will add a little bit over $1,000 to our cash flow, right? And these are all things that are conceptual, but like I said, I'm going to give you guys a tool that you can use, a plug-and-play tool that will help you manage your DII, your DSO, your DPO. So it's not going to be a mystery. It's going to be something that takes you 10 minutes a month to do. And then the last lever on the balance sheet is, paying your bills 1 day slower, right? Getting better terms. Listen, Home Depot pays their bills in 60 days. Coca-Cola pays their bills in 120 days. Walmart pays their bills 60 days. These are companies that could pay their bills on day 1 or day 2. Coca-Cola waits to day 120 because it's good business. That makes them less dependent on Wall Street. They're making their vendors their banks. Well, Walmart last year, they bought back stock. They didn't sell stock. They bought back stock. They bought back treasury stock. They're so, they figured out how to be just so little dependent on Wall Street. Okay. Paying slow, if you can do it, is a good tactic. But like I said, for small business, it's a very slippery slope. But if you are aligned with your vendors, that you're a valued customer to your vendors, then you can ask for longer days. 45 days, you're not asking for the moon, right? If you're getting 30-day terms and you ask for 45, you give it a go. All right, so let's summarize what these 7 levers did. The price increase was $10,000. The selling more was $6,000. The better sourcing gave us $4,000. We cut overhead to the extent of 1%. That gave us another $4,500. 1 day reduction in our collection period. 1 day reduction in turning over inventory faster. And then 1 day paying our bills 1 day slower, and we got to $29,500. Let's call it $30,000. This is roughly 3% of our sales. So this is a company that was making 15% net profit margin. We just improved, our cash flow to the extent of 3% of our sales. That's 1/5. That's 20%. That's a 20% improvement on our cash. That's amazing, right? And that's just from a 1% solution. So, the point here, guys, is that, there are 7 levers here. And some of these levers just aren't realistic. I don't know that you can collect your money one day faster in a pandemic. I just don't know that to be the case, right? Everybody's paying slow. And so that may not be a realistic lever. But a 1% increase, a 5% increase, that you should really look into, right? Can you better source your labor and materials? Probably not. I mean, because we know that there's been such fantastic inflation in everything, in materials and labor, right? It's hard to find employees right now, at least in Atlanta it is. And as far as commodities go, I mean, I just read yesterday that lumber prices have increased over 300% since before the pandemic. I mean, I don't know that there's a opportunity to better source materials and labor. And I don't know that there's a solution in selling more, but I would say a price increase, an overhead decrease. Those are 2 easy levers that you can really look at, okay? With respect to the levers on the balance sheet, can you collect faster? Can you improve the DSO? I don't know. I doubt it, right? Can you pay your bills slower? That's something that you need to look into. I mean, you know, if you're a valued customer to some of your vendors, that is something to discuss. Maybe it's not a 15-day improvement. Maybe it's a 10-day improvement. Either which way, that's huge. And then reduction of inventory, absolutely. If you guys have it, if you're in a business that has inventory, you're not a service-based business, this is something you need to look at. So, you know, this goes towards strategy. This goes towards, you know, sitting down with your team, whoever's on your team. It could be you and your spouse. It could be you and your manager, whoever's on your team, and put this front and center, you know. And each month, how am I doing? How are we doing? How's it going? And so you need tools for that, right? And so we're into the tools section. And, you know, if you're just managing the P&L, the 4 levers on the P&L, this is a budget. I'm not sure who you know, which guys out there are using a budget, but, you know, this is a budget. Hopefully you can see this, but we put down the budget amount for each month. We put down the actual. We get it from our QuickBooks. This will take us 10 minutes to do, guys, right? And then everything is shown here, summarized as a % of sales. Everything, we always make sense of our numbers on the profit and loss statement when we show it as a % of sales. And if you're doing a price increase, that's going to be reflected as an improved gross profit margin, which is, you know, a higher margin, a higher % of sales. And that will be the same case if we're better sourcing. It'll show up as an improved gross profit margin. And we're doing a price increase, you know, all those things will show up in the top. The price increase, the better sourcing, the better sales. And with respect to overhead, you know, doing better managing of our overhead, well, that will show up, you know, in the whole section below the gross profit margin in the total expenses. And so this is something that will take you guys 10, 15 minutes a month. You print your financial statements by the 10th of the month. You take out your budget worksheet, your Excel budget worksheet. You put in your actual compared to your budget. You look at it, you study it. How am I doing? How am I doing on these levers, right? And then we'll go to my scorecard. This is a scorecard that I created about 10 years ago. I presented this at national conferences. I distribute this everywhere, all over. It's being used far outside of Georgia. And this pulls all the levers together. This has the P&L and the balance sheet. And I'm not sure, it's very small on my screen. I hope it's bigger on your screen. But all you need to do once a month is to fill in the gray squares, right? The gray boxes. I mean, everything is automatic other than the gray boxes. This takes 10 minutes a month. And so what we do is all this will go in here. it will show you your performance as a percent of sales. And we compare our performance against benchmarks because that's the magic, setting benchmarks. We're setting a benchmark for a gross profit margin of 50%. And we compare our actual against the benchmark. That's the magic, guys. Setting these benchmarks and comparing against our actual against the benchmarks, and then taking timely corrective action. That's the magic. And so this company has a benchmark of 50% gross profit margin, 15% net profit margin, and then you need to see how you're doing. You know, if this company's doing $1 million a year in sales, it sets a benchmark of 50% gross profit margin, and they're not doing their monthly 10th of the month, and it turns out they're really only doing 40% gross profit margin. That means they're giving up 10% on $1 million of sales. That's $100,000 that's coming right out of their bottom line. So this is something that we need to be doing every single month. This is the profit and loss statement. And then on page 2, we put in the balance sheet. You know, this takes all of 10 minutes. And this will populate all the balance sheet. And it will filter into the cash flow statement. And I said to you guys at the very start of this session that if you guys are managing your AR, your AP, and your inventory efficiently, that your cash flow from operations is going to be equal to or higher than your net income. This is something that you want to do every single month. Now, you probably have never done this. In fact, I dare say that of all the attendees on this program, I would say to you that maybe 5% of you have ever seen a cash flow statement. And now the 5% of you guys who have seen a cash flow statement, maybe 30% of you guys who have printed your cash flow statement understand it. It's just not user-friendly. It's not intuitive. And I'm not sure that your CPA has ever really shared it with you and walked you through it. But this scorecard simplifies it. And if you know that your cash flow from operations needs to be equal to or higher than your net income, and it's not, then I can tell you that it's in your inventory, it's in your AR, or it's in your AP, and then that takes us to the third page of the scorecard, which shows us all of our ratios, all of our DII, our DSO, and our DPO, days in inventory, days payable outstanding, and days sales outstanding, and what's happening. And maybe David will invite me back for another session, and we can really take a deeper dive into this and further empower you guys as small business owners, okay? And it'll be my pleasure. And so I know it's 12:58. You know, after the session's over, Ryan, David's assistant, will send you guys the scorecard in Excel, send you the budget in Excel. We'll also even send you this this little Excel worksheet here, which shows what would happen if you do a 5% solution in your business, right? Or whatever the solution is. And so this could be your strategic plan. When you get together with your management team, you guys can use all these tools, feel free, right? And if you guys need assistance, you'll call up, you know, the Kentucky SBDC, and you'll work with a consultant, and he'll help you. All right, David, that's what I got. If you want to open up the questions, glad to answer some of the questions.
All right, that was awesome, Andy. You know, what I like about this is that you know, some people know when they look at their business intuitively what they need to do. You know, and I'm not one of those. You know, Steve Jobs comes to mind when he went back to Apple, you know, to save the company, and you know, in a matter of a year, he had, you know, revolutionized all the products and just changed the industry, and suddenly they were successful. You know, I'm not that smart. I don't think I could do that, but I could come up with some things to save or improve things by 1%. And that's what I like is about what you talk about is this, you know, step-by-step process. So hats off to that. The problem is that when I ask about the balance sheet, you know, small business owners generally, I think, have a hard time having an accurate balance sheet. Do you have any tips for them to work through that?
Well, if it's a service-based business, David, I would say to you that there shouldn't be any issue with the balance sheet, right? I mean, they should be invoicing the clients timely, right? And so they need to know what the receivables are timely. When they get vendor invoices in, they need to enter the vendor invoices in timely so they know what their accounts payable are. If it's a service-based business, timely entering of invoices and vendor invoices, and David, they need to reconcile their checkbook by the 10th day of the following month. They need to reconcile their checkbook. These are just, if they're using QuickBooks, it takes a minute. And I know I'm a CPA, but I'm telling you, QuickBooks, they've dummied it down so easy. So it should not be anything that's intimidating. It is so easy. And in Kentucky, all over, if you go online, you can find a QuickBooks Pro Advisor, 100 of them within 15 miles of you, right? You just get one little tutoring session for $40 to how do I reconcile my checkbook, reconcile your checkbook, enter your transactions in timely. The balance sheet's going to be perfect. You got inventory, then there needs to be a system for a POS system. If you're a manufacturer, that's a different conversation, but I'm glad to have that conversation. But then inventory needs to be managed, and at the end, on the last day of the month, David, there needs to be an inventory count. And so this is really not that hard. It sounds scary, but it just isn't hard. Restaurants take inventory once a week, so good restaurants take inventory once a week. So take an inventory, and if they have a problem with the balance sheet, David, I'm telling you, they are only a few days away from it not being a problem. It's just reconcile the checkbook, getting the AR and the AP correct, make an adjustment, cleaning it up. They are 3 days away from being in good shape as far as evaluating where they're at.
Yeah.
Reconcile the checkbook.
Diane wants you to know that she says this is something I absolutely never heard in college. So
I believe that 100%.
Yeah.
Diane went to college, and they taught her in college about maximizing profits, maximizing shareholder value, maximizing owner value, right? They never told her one thing about the balance sheet. No, agreed. I have an MBA from a very fancy school. No way. Never heard this stuff before.
Mary would like to know, do you have any guidelines on what percentage your rent as part of your sales should be? So
that is really industry specific. If you're a retailer, I would say to you 7-8%. If you're a restaurant, 7-8%. If you're a restaurant, and I'm sure there's a lot of restaurateurs on this call today, if your rent is over 10% of sales, you're making it really difficult on yourself, right? So it really depends on the nature of the business. But, as a general rule, 7-8%, maybe 10%. If it's a business that works on really healthy gross profit margins, then they can afford, a higher rent. But if it's just, sort of, not a high margin business, they can't afford more than 7-8%.
Sloy just says, I can't wait to go through these sheets with my accountant. Cynthia would like to know, how would you handle inventory costs that only turn 18 to 24 months due to aging?
They only turn 18 to 20. Okay. So that would be a business that could be a jewelry store, right? A jewelry store that has very slow inventory turnover, but hopefully it has very high margins, right? So, but if this shop or this business has slow inventory turnover and it works on tight margins, this business is in trouble. They need to cut inventory. That's a whole different conversation. They need to cut inventory. Now, this person, David, you should get her name and get the nature of her business. I have a guide of inventory, days in inventory turnovers for different types of businesses. I'd be glad if you get it, send me an email. I'll send you back what the DII should be for that particular business.
Okay, thank you. All right. Is there an easy way to calculate the cash gap that you were talking about earlier on?
Yeah, because if you're using the scorecard, David, I mean, the DSO is a formula. The DII is a formula. The DPO is a formula. These are gotten right on your balance sheet. So, I mean, DSO plus DII minus DPO. I mean, that's all it is. That's the gap.
Okay.
How many days to get it? How many days to collect the money? That's DII plus DSO. The money goes out on the DPO. So the days it takes to get in minus the days it goes out, that's the gap. So DII plus DSO minus DPO, that's the gap. And this client of yours, this attendee, pretty much has a sense of that gap, you know. But until they start using a scorecard where it's plug and play, they won't know exactly what the gap is, but they probably have a sense what the gap is. They probably know how long it takes them to collect the money, how soon they pay the money, how many days inventory perhaps, but it's all formulaic. It gets right from the balance sheet. There's no magic, no magic.
All right. Just like to remind everybody there in the chat, there is a link for our survey. If you guys wouldn't mind clicking on that on the way out and take that survey for me. It's kind of important for our stakeholders and funders. Paul says, this was an excellent presentation, Andy. How do these sessions earn CPE credit for CPAs? I don't know if we do that.
Right.
This certainly was CPE level. I think it was really good information for everybody. So it looks like that's about the end of our questions today. Andy, this was spectacular. Let's you and I talk about coming back again really soon. I think everybody really enjoyed that, and I would too as well.
Super. David, thanks for having me. And it was my pleasure. And
we'll send you everyone a link to recording today, so you can watch this over and over again, as I really do. And you'll have Andy's contact information. Please reach out to Andy if he can help you out. He's like me. He's an SBDC consultant. So we're here to help you, and that's what we do. We enjoy it. So, Andy, thank you again.
Got it.
And thanks, everybody. We'll see you next Wednesday.